Okay, we're jumping into part 2 of the life insurance policy that I had no business buying. Okay, I'm diving into the nitty-gritty of the whole life insurance policy I bought at 23 years old and how it could have cost me over $900,000 if I kept it. Let's get into it. All right, welcome back everyone. If you missed part 1, make sure to check it out here. And if you're new here, this is your investing coach, Wahira. This is where you can learn how to invest and build generational wealth, even if you're the first in your family to do so. All right, let's break down my actual policy. This policy right here that I got when I was 23 years old in 2015, so 9 years ago. That's the exact policy, the exact papers that was sent to me 9 years ago. So I absolutely felt a type of way when that policy came my way, and that's why I kept it for 9 fucking years. I got the policy in 2015. At the end of 2019 or the beginning of 2020, I surrendered the policy. In 2019, I had an in-force illustration sent to me. So an in-force illustration is essentially a check-in on your policy, essentially seeing how it's doing so far and what to expect it to do in the future, like investment wise. So, as a recap, I was paying $1,800 annually for this policy with a death benefit of about $181,000. So that means if I kept paying into the policy $1,800 annually, when I passed away, my beneficiaries would have a guaranteed payout of $181,500. Sounds decent, right? Honestly, when it was first told to me, I was like, yeah, that sounds really good. It was more money than I had ever had in my life, so I'm like, that sounds great. It's guaranteed. Little did I know that it's super expensive. All right, let's take a deeper dive into the policy. So here you can see the insurance column, and this is the non-guaranteed death benefit. So when I would have passed, the policy would have to guarantee me the $181,500, right? But the policy could also grow, and they could give me more than what was guaranteed. But remember, the only death benefit that is guaranteed, if I kept paying my premiums, is that original death benefit amount. So with this policy, the death benefit could increase depending on what dividends were being paid from the investments that we were in. So you can see in the second column here, labeled dividend, that these are the estimated dividends that Northwestern Mutual estimated the investments would give out, and then they would reinvest it back into the policy, making that non-guaranteed death benefit increase. And of course, these calculations are estimates. Northwestern Mutual, where I got this policy from, was using historical data on what their investments have done in the past and like what expenses the policy has incurred as well. And quick note, dividends, if you're not aware, they are payments companies give to you for being invested with them. So just like an incentivization, like to incentivize you to keep investing with them. So hence why you see the insurance column, which is the non-guaranteed death benefit, go up year over year. So in the third column is the annual premium outlay. And this is the annual payment every year to keep the policy going. So for this policy that I had, it was $1,800 a year. The NA that you see there for the year 4, that's because it's there because the 4th year was when the report was ran. So in this table, at 65 years old, that has me paying into the policy for 42 years. I would have to put in a total of $75,600. And my guaranteed death benefit would be $186,710. And the non-guaranteed death benefit could be $374,172, depending on how the markets do, right? If I had taken that $1,800 a year and invested it on my own, so took $1,800 every year for 42 years and invested it, at 65 years old, I would have $545,000. So how did we do this calculation? We took $1,800, for 42 years, and we had the rate of return at 8%, which is industry average, right? So it's industry standard. And that's how we got $545,000. Again, the life insurance policy estimates that if I pass away at 65, it could potentially pay out $346,000. So that's a big difference. If I invested the money on my own, I would have about $545,000. Insurance payment is about $346,000. That's a $200,000 difference. That's a lot of money. This is why life insurance is so expensive. Okay, let's take a look at a few other numbers. What if I were to pass away way later than 65 years old? I mean, I sure hope so, right? Like, let's cross our fingers, like, knock on the wood. I think this is plastic, but whatever. But yes, hopefully I do live past 65 years old. That's why I'm doing all these pull-ups, okay? Like, so I can have muscle when I'm 80, right? Like, we're trying to stay strong all throughout our lives. Okay, anyways, the life expectancy for women in 2022 in the US was 80.2 years old. So stats say I've got a lot of years left to live, all right? And with the whole life insurance policy, the policy pays out when the insured dies. So let's round that up and look at what the life insurance payout would be if I were to pass away at 81 years old. I'm also choosing 81 years old because the policy has projections for that. So let's keep the math easy, right? And we love keeping things simple. So if I were to pass away at 81 years old, the whole life insurance policy says that they may pay out $485,500. If I invested that money, estimating a 6% return on investments from age 65 to 81, which is again industry average, I would have about $1,390,000. That's about a $900,000 difference, right? We're taking $1,390,000 minus $485,500. That's over $900,000. That's generational wealth money. Let's not leave it on the table, or in this case, in a whole life insurance policy. And I do want to point out with this math, because we said in the policy, they stop in their projections, we stop paying into the policy at 65. And in this math, I did that same math, right? Like from 23 until 65, those 42 years, we had $1,800 going into that every year. And then from 65 to 81, we were just having the investments grow, not putting anything else into it, right? And we did pre-65 was an 8% return on investment. And then after 65, we had a 6% return on investment. So industry average. And these are the numbers that came out. Wild numbers. This is why life insurance, whole life insurance, is so expensive. And it's also why insurance policies aren't great investment vehicles. And why would they be? They're not meant to be investment vehicles. They're for insurance at their core. And now, I'm not saying that whole life insurance is never the answer, right? There are times where this type of insurance makes sense. It all boils down to who relies on you financially and for how long. Whole life insurance can make sense if you have a dependent who will rely on you financially for their entire life. Not your entire life, their entire life. So for example, if you had a child who had a disability and relies on you financially, but a situation where a young person with no dependents, just starting off in their career and just starting to build wealth, a situation where they need whole life insurance doesn't come around very often. But we're still sold these policies. And that's one of the reasons why the industry gets a bad rap. Who would have figured? For most people with dependents, term life insurance might be a more suitable and affordable option. Really quickly, what is term life insurance? Term life insurance covers you for a specific time period, so a term. Most of these policies can go up to 30 years, but you can have a less years covered if you want. So let's say you just had a kid and you want to make sure that this kid is covered financially if you were to pass away, but you want them to be covered financially until they're an adult. So what can you do? You can get a 20-year term policy, and at the end of the 20-year, that child would now be able to work and earn their own money, so they're now not dependent on you. And at the 20 years, if you didn't pass away, a payout didn't happen and the policy just dissolves, it goes away. So worst case scenario, there is no payout and you get to live. Doesn't sound so bad to me. And because there's no guaranteed death benefit attached to these policies, it's a lot more affordable. It's a ton more affordable. Like, you can get a lot more coverage for a fraction of the price that I was paying for the whole life policy. So term life insurance may align a lot better for what your needs are, and it aligns better with what the purpose of life insurance is: protecting those who rely on you financially. All right, everyone. If you found that helpful, please let me know in the comments. And also, if you want a deeper dive into the differences of what a term life policy is and what a whole life policy is, let me know, and I'm happy to do a deeper dive in a new video. But yeah, just leave a comment. All right, make sure to come back every Sunday for new and action-packed videos. And remember, this is not financial advice. It's just for educational purposes. It's really to help you build your investing knowledge and for you to start building your wealth and generational wealth. So, because we are done gatekeeping here. All right, everyone. Thanks so much. Chat later. Bye. I have recorded this 3 times, but for one reason or another, we have lost it. So, time number 4, 4th time's the charm. I basically have this memorized by now. The script is memorized. All right, everyone, let's go again.